David Harris. He is with CLA, CliftonLarsonAllen. They are great members, great support to the association. He is here to instruct us on financial statements, and hopefully this will be something that you'll gain something from. I'm sure you will, actually. David can introduce himself, more of the details and so forth. He's a Utah boy, and we appreciate very much him being part of this class. So David, we'll just turn it to you, and thank you again for participating in this, everyone, and David for presenting.
Dave, thank you. I appreciate that. I am a Utah boy, right? I grew up down in Oak City, so not just a Utah boy, but a small town Utah boy. And so it's good to be here today. So, you know, the topic is financial statements, understanding, utilizing, and suggestions. And so if we can get through this and you've walked away with just a couple tidbits that help you in what you're doing, we'll call this a success. So in introducing myself, so I am by title a BizOps CFO. What that means with Clifton Larson is I get a chance to work with companies like yourselves, owners, accounting departments, and I get to help them improve their financial reporting, help them understand the reporting, and just give them some guidance. And so hopefully I'll get a chance to share some of that information with you in a useful way. A little bit of information on the firm I am with. Let's see if it can take me a minute to get this working, it looks like. Okay. Clifton Larson. Clifton Larson is probably one of the largest unknown firms here in Utah. We're about the 8th largest, I think we are the 8th largest firm in the United States. Pretty new to this market. I've been in Utah maybe 5 years, and but named Construction Executives top accounting firm in the United States, 120 locations, 6,200 members. Been around a long time, and we provide all sorts of services. So that's just a little bit of information on Clifton Larson, little information on myself. And with that, let's get moving here. So what I want to start off with are our discussion points. We've got an hour, and we've got a lot of stuff to go over, so we're going to go pretty quickly on things. But if, Dave, you can help me manage some of the questions that come through, if you have them. It's not a big group, so we can maybe have more of an intimate kind of conversations. But let's start off by talking about this concept right here. Every company has a story. Doesn't matter what kind of company you are, but you have a story. And that story is told to various people. Might be banks, might be insurers, and what I would say is the most important user of your story is yourselves as business owners. So but that is the purpose of the story. And so what we're going to talk about today is how do we tell that story? And we tell the story through the use of financial statements. So we're going to talk about financial statements, going to walk you through those. And then we're going to talk about applying some of the information to the financial statements. And then I want to end by talking about some of the common pitfalls. These are some of the things I see all the time, and they're very common, and want to just give you a couple suggestions. So with that, let's go to the first point here on what financial statements we're going to talk about. So there's a basic set of financial statements. We've got the balance sheet, we've got an income statement, and oftentimes you hear that income statement called a P&L or profit and loss statement. Just know they're the same. We've got the statement of owner's equity, and then the statement of cash flow. Statement of cash flow is one of the most underused of the basic set of financial statements, but it's one of my favorites. And I'll hopefully give you a little bit of insight on that. And then we're going to talk about the job schedule. So those are the statements we're going to be talking about. And please remember, as we talk about them, we're telling a story. And what does that story mean to us as we go through these financial statements? Now, I want to take us back a little bit further to the transactional level. We're not going to get into detail today about transactions, but I want you to understand that all an accounting transaction is, it's the capturing of your activities, right? Our activities in the business is quantified and it becomes an accounting activity. And every accounting activity is assigned an account by type. And I want to give you a visual of what that means. So if you can visualize an account, every account is like a bucket. All right, so we capture a transaction, goes in the bucket. Now these buckets are assigned to a type. So every bucket is going to be either an asset, a liability bucket, equity, maybe a revenue, maybe an expense bucket. And then these buckets types are classified into two other areas, balance sheet and income statement. That is how in accounting we organize transactions that are captured. And if you can grasp that concept, when we go to the financial statements, it's going to be very clear as to what we're looking at, just these different buckets. Now, as a matter of a rule, every accounting transaction is always recorded twice, meaning it's either put in one bucket or another bucket, or maybe even twice in the same bucket, but it's always twice. And let me give you an example. So say we buy a truck, and let's say we paid cash for it. Well, in this example, you've got an asset that you're spending, right? You're giving money away, so the money comes out of that bucket, and you're getting what? A truck. Well, that truck is going to be put back in the bucket. In the case if it was a loan, you would have a loan recorded in this bucket here, and you would have the asset in the other bucket. Always the case. And that's how accounting is structured. Now, what does that mean to our financial statements? So we're going to talk about a balance sheet to start off with. Okay? Now, a balance sheet is like a snapshot of the business at a period of time. It shows our financial position at any given time. So if you think about it, it's not a period of time, but a point in time. And so we're going to talk about the components on a balance sheet here. So in our assets, right? So we've got assets. It's easy to see that these are assets, items of value. Okay? Cash, accounts receivable, fixed assets. And those items are broken down even further. This is an important concept, is that all our assets can be defined as a current asset or a different type of asset. Now, a current asset is any asset that is likely or expected to convert to cash within a 12-month period. So cash is an easy one, right? Because it's already cash. So by definition, it's a current asset. Accounts receivable. Well, we hope to collect accounts receivable, turn it to cash within maybe 30 to 90 days. So it shows as current. Some of these other items, inventory, we expect to consume inventory within a 12-month period. Prepaid expense, right? We actually spent cash, but we're going to consume the benefit over 12 months. Important concept in understanding your balance sheet. So you've got your current assets. Now, if they're not current, then they have to be non-current. And non-current simply means that they're either going to convert to cash or they're going to be consumed as an asset over a period greater than 12 months. Fixed assets is a good example. If you have a truck, it's likely going to last for more than a year, right? So by definition, it's a non-current asset. And then those added together equal assets. Now let's go into the liabilities. Very similar, except you've got things that are owed, like accounts payable, credit card payables, billings in excess. That's an important concept for contractors. Current installments of debt. Then you got these items down here, added together equal total liabilities. Now, just like your assets, your liabilities can be defined as current and non-current, whereas a current liability is going to consume your cash within a 12-month period. Whereas a non-current is going to consume your cash after 12 months. And that's going to be an important concept as we talk about interpreting the financial statements here in just a moment. The last section of your balance sheet is the owner section. Okay, you've got your, if you're a corporation, you've got your shares that were issued, you've got amounts paid for the shares, you've got your retained earnings. So owner investment, stock issuance or invested capital. That's what this is. Undistributed earnings. Now I want you to look at this dollar amount because it's going to pop out at you when we look at the P&L. But in this example we're going over, this is a new company. Just remember that they are a new company. But this retained earnings amount down below is undistributed earnings, meaning it's a collection of all the company's earnings over its life, less the dividends and distributions. So undistributed earnings. Now, rules in understanding the balance sheet. As I mentioned before, every accounting transaction has two sides of the entry. Notice that the balance sheet says balance, right? They're assets and liabilities. So what does that mean? Simply this. Total assets have got to always equal total liabilities and owner's equity. If they don't, you have a problem in your financial statements and your story's not accurate. Now, it might surprise you how often this happens, but it happens all the time. But if an entry is recorded here, there's either an offset here, or an offset here. And same with down here. Always an offset, and that's why it's called a balance sheet. Assets equal liabilities and owner's equity. Now, some of the understanding and some of the application of the balance sheet in understanding your story is this. Remember that concept of the current assets and current liabilities? Well, a banker, myself or yourselves, should be able to look at your balance sheet and learn about your liquidity. How would I learn about your liquidity? I'd look at your current assets and your current liabilities, because if that's going to convert to cash in 12 months, that's going to consume cash in 12 months, then the difference is going to show whether I'm going to have cash or not have cash in a 12-month period based on the snapshot taken today. So banks will look at that to see about the liquidity of your company. And in this example, you can see that our current assets exceed our current liabilities. So we have positive net working capital or positive net assets versus net liabilities. So as a key ratio, we compare those two by taking your current assets divided by your current liabilities, and that tells us this current ratio. And you can look at that current ratio and say, if that thing's under a 1, that means you've got more current liabilities than current assets. You're going to have some liquidity problems possibly. So it's a weak position. Fair is having 1 to 1.5, and you can see in this example it's 1.4. You know, it's an okay position, but you got to watch it. Now, a strong position would have double this over this. And that doesn't happen all the time, but that is considered a really strong position. So you can look at that, check your liquidity. Another thing that banks will look at is your debt to equity. Now, banks expect you to put skin in the game, right? If they're going to loan you money. How do they know what skin you have to put in the game? They look at your equity. They say, well, you've got this much that you've got invested in your company. Well, how much do you have from third parties in that to fund your company? And they'll look at your liabilities. And then they'll compare the two and they'll say, okay, I expect you to have this much in the game versus your total liabilities. So that's called debt to equity, right? Debt meaning total liabilities versus your total equity. And you can divide total liabilities by your equity and look at that to see the strength of your company from an owner's perspective. And if it's greater than 2 or it's negative, then you're highly leveraged, right? This number is really high. And that'll be a red flag to the banks, basically saying it's got a lot of debt to cover, or they're not willing to put skin in the race. Ideal is 1 to 2. Strong is under 1, But if you're under 1, that means you could probably afford to go out and get financing possibly. So this is an important concept for you if you're looking to get financing. The other thing that'll happen is that when you do get financing, they'll restrict you to certain debt ratios, and they will limit your ability to pull money out of the company to maintain a ratio. So that's some of the pieces that we look at on the balance sheet. Let's go to the income statement now. Whereas the balance sheet is a snapshot in time, the income statement shows your performance over a period of time, right? Snapshot versus period of time. The different components, which I think you guys are probably all aware of, is revenues, cost of sales. I want to talk about a second about cost of sales because this gets confusing to folks sometimes. In cost of sales, you've got direct and indirect, meaning these are field-related costs, things that are specific costs generated because you're out doing work. If they're direct, that means they're identifiable to a specific job, right? Labor. I go work an hour on a particular job, that's a direct labor. I go buy a material for that job, it's direct material. Indirect is a little more ambiguous, meaning that it's probably a cost that's shared across multiple jobs, but it's still field related. So your cost of sales would be the combination of both. And sometimes these indirect costs are confused with G&A costs. After you take your revenue minus your cost of sales is your gross margin. Now the gross margin for a contractor is a key measurement that you want to look at. Oftentimes will drive your bids, and you want to make sure that that number is sufficient to cover other costs, which we're going to talk about. Then you have your G&A. G&A related costs are all those administrative costs or non-field related costs that you incur to run your business. Now, some things in here, some people can sometimes code these indirect costs down into here, and I've seen allocations where they'll move them back up. Okay, that gets a little more complex, but just know that sometimes your indirect costs are down here. You may want to move them up, and the other costs would be strictly G&A. An accountant perspective, you think of my perspective, I mean, all these years, what am I looked at? I'm looked at as G&A, right? Because I don't do work on the jobs. I keep the office going, and that's where I fall down here. Then you've got your other items, which can be interest and other types of related items. And then you end up with revenues minus expenses or costs, right? This number, this number, this number equal your income. It's as easy as that. And I think a lot of us know this flow, and we're used to seeing it. Now, what's the story that we can learn from a P&L or from an income statement? When I get financial statements, one of the very first things I do is I go right to the bottom line, and I work backwards. So I come here and I look at my net income and I compare it against my sales, because everything I do, I compare against the sales. And I like to take this and divide it by my sales to give me my net income as a percentage of sales. And this tells you if you've made money or not and how much I made. In this case, I put all this money into or generated this much money after all my costs. I made this, which is 9% of my sales, okay? And the right number for that to be, it depends on where you want it to be, and it depends on a couple other things too. But certainly if that goes negative, that's a problem. If you're 1 or 2%, that's living on the edge a little bit. Maybe times are tough, but you want to generate this, push this number up. Now, then moving back up the scale, where do I go next? I often go to the gross profit margin, because that's a real indicator as how effective I am in my actual jobs that I'm doing. Now, this margin will depend on the type of work that you do, but I see a lot of times trying to be, 25, 35 kind of level. because you know that your gross margin has got to be enough to cover all the G&A and your other items and leave you a profit. And companies will look at this month to month to month to month and compare. So the next thing I do is I go in, I look and see my costs. I want to see my costs as a percentage of revenues. So my overhead, right, 17%, 17% might be a little high, right? Maybe I want it to be 10%, maybe 15%. Cost of sales, look at that. But the other thing I'll do is I'll apply it on a line item basis. It's good to look at your labor as a percentage of sales, your direct labor, right? Because you guys will know specifically how much labor you're incurring for your jobs and what you bid out at and what it should land at. So you can look at the percentage right here. And what's really useful is if you can do this in a way that you can run your financial statements that show multiple months, so you can compare month over month over month over month, see where it trends. And you'll see if you've got some problems or see where there's anomalies and things that you need to look at. I've got a client that when I started meeting with them, it was over a year and a half ago, actually a roofing company. They were not getting financial statements. And they did not know where they were landing ever. And he was staying up at night. He was uptight. And we sat down and we talked about this. And he had an accountant. And so our goal was to get that accountant up to speed and trained so they could get these financial statements for him on a month basis. And now, fast forward, they're looking at these every month. And now because they see these percentages, they're going, you know what? My auto, why is that percentage, such a high percentage this month? We're going to drive that down. I want my overall G&A not at 17%. I want it to be at 12%. So then they started making decisions to control these costs. The other thing that was a concern to them is that their direct labor was higher than what they expected. So they talked to their foreman. They're making sure everybody was efficient, and that's how they used their story to make decisions. And now they're much better, making much better decisions. The next financial statement that we're going to look at, and we're going to just go through this one pretty quickly. This is the statement of owner's equity. And this just gives you a summary of that equity that you had. Now, remember how I mentioned that there was a new company? So in this report, it starts off with 0 because last year there was nothing. Well, they issued shares of stock and the owners paid $36,000 into the company. During the year, they made $235,000. Remember that number? And I think we showed that. Let me go back to the P&L. Remember that? 235? That rolls into this report, which also rolled into the balance sheet. You saw where that came from. They didn't distribute any of this. Now, what can we learn from the statement of owner's equity? Think of it this way. If I go and take $1 and I take that $1 to the bank, that bank's going to pay me a certain percentage. Okay, and that percentage is going to be a return on my money. Well, rather than take that money to the bank, I'm going to invest it in the company. So if I invest it in the company, I would expect the company to give me a return commensurate with the risks that I have by putting that money in the bank. So one thing you can look at is this return on equity, which is just what I talked about. It's your income divided by your equity. So in this case, 235 is my income and my equity, maybe my beginning equity is 236. It was an extremely high number, but it's not usually the case. I worked for a company that their goal, and they were a very large company, wanted a return of about 15%, 15% on an annual basis. But if you look at this and this return goes negative, it's obvious to see that your equity got chewed up. You lost money. But the other decisions to make is you could say, am I better to leave money in the company because it can generate a high return, or am I better to take the money out put it in the, in my own personal savings account. And you can tell that by just looking at and understanding your return on equity. And that's what you use this statement for. Excuse me. All right. Statement of cash flow. This, as I mentioned, is one of my favorite financial statements, but one of the most underutilized financial statements of all. And if you think back to the buckets where transactions go, they weren't put into buckets by way of the cash flow statement, but they were put on by the way of balance sheet, income statement, right? Well, if you're an accrual-based company and not cash-based, your balance sheet is always fluctuating, and you know that your income doesn't equal your cash. So you use the statement of cash flow that pulls the income statement and the balance sheet together to paint a picture as to what happened to my cash. And it's often used as the basis for cash projections for a company to see if you're going to have positive cash flow. So let me show you how this works. We're not going to go through it in detail. I just want to show you the high level idea as to how it functions. So all your balance sheet is classified by type on a statement of cash flow. For example, if I look at a statement of cash flow and I look at this line item right here, that tells me how much cash I generated from or used in operations. So it takes your net income and it shows the changes in your working capital accounts, which are basically all these current assets and liabilities. And the difference is your cash flow. And that's your cash flow from operations, which means that you've got that much cash to do non-operating stuff. And what's that non-operating stuff? Well, you've got to buy fixed assets, right? So this section tells you how much you've bought in fixed assets or sold in fixed assets. So you can see this month or this year, I generated 351, but I consumed 216 for fixed assets, which leaves me enough money for financing. Maybe I've got to pay debt. And so here's some examples as to debt or investments by the company. So I generated that much money there. Which when added together, equals your cash flow for the year or for the period of time. You take the cash flow generated or used plus your beginning cash, and in this situation it was zero. I ended with cash at 275. So my purpose here is not to teach you how to do a statement of cash flow. It's mainly just to introduce the statement of cash flow to you. And if your accountant doesn't provide this to you and you're an accrual-based company, you might want to talk to them and ask them to sit down with you and go through your statement of cash flow, because this will start painting a picture to you as to what's going on with your cash if you've ever wondered what's happening to your cash. And then you can project out based on these numbers too. All right, those are your basic financials, which leads us to the next statement. For contractors, a job schedule is critical. And if you're not doing job schedules and you're wanting to understand your jobs, you need to do a job schedule. And a job schedule is just a summary of all your jobs, right? You ought to be able to run a job report for every individual job, but then you ought to be able to compile them to where you can look at them and paint a picture from a kind of a high level perspective. And so this is a simple job schedule, and it's broken into two parts: completed contracts and uncompleted contracts. And I always recommend that whenever somebody, particularly in large jobs, when you have a large job, you ought to run a job report for that job, and you ought to look at the margins, right? Look at that gross profit margin. Look at the revenues. Look at the costs, direct cost materials as a percentage of revenues, and compare it against your bid. And then sit down with those doing the bids, sit down with those guys or people doing the jobs themselves, particularly if there's anomalies, and get to the bottom of it. But I would do the takedown at the end of every job. Now, sometimes resources don't allow to do that, but it's just a recommendation, if at all possible, to do that. But then on a monthly basis, get this report, have your accountant put it together, and look at these things. And this is some of the major components here. You got your contract amount, the original contract amount. This may have to change by change orders, but you got your contract amount, you got your cost to date and estimated cost to complete, which gives you total costs, which contract amount less your estimated is going to be your estimated gross profit. Now notice our gross profit margin. You know, in theory, this gross profit margin is going to tie back to your P&L. We won't get into that, but it's a kind of an important piece, but for your accountants. But the main thing for you guys is to understand that this tells a story. Now, I oftentimes like to ask the group what you see, what you can learn by looking at this job cost schedule. So rather than, since we're doing this online, maybe I could just have you look at this for a moment. And if I were to ask you what things would jump out at you, think about it, and then I'm going to point some things out and see if we hit a common chord here. All right. So a couple things I'd point out is this, is sometimes in business, some guys want to just grow their business, right? I want to grow my business. Well, what they might be saying, I want to grow my revenue, but you're not growing your business unless you're generating income, and that equity piece is growing. That's real growth. So if you look at this particular job down here, that 2.5 margin, here it is, right? That's that sexy growth, lots of growth, but maybe labor costs are up. Maybe it's harder for you to control things, but look at that profit. If you generate a gross profit margin of 2.5%, and you know that your overhead is a 17%, you're going to generate a loss. Even on the BYU Conference Center, you know, 12.5%, still pretty of a low margin. If you come back here, you might go, oh, my sweet spot might be this particular job for whatever reason. And you can gain that understanding by looking at this sheet by job. The other thing that's not identified here is if you use the percent complete, you can see the status of your job by comparing your costs to date versus your total cost. And that'll tell you percent complete, which drives revenue. So anyways, job cost schedule, important for you guys, highly recommended. So let's shift gears now. So we've got 20 minutes. So go through here. We might have some time for some questions at the end. But I want to show you some of the common pitfalls that I've seen throughout my career, and I continue to see, and it's actually surprising to me how often I see this. These pitfalls cause it to where you won't be able to understand your story. Causes that you won't be able to tell your story. Other people won't be able to understand your story. And if you can address some of these things, it's going to help your story to be more clear. Sometimes financial statements can be intimidating, and frankly, they can be intimidating because they can be too complex, or they can provide information that you scratch your head about, right? So let's look at some of these reasons, what's going on here. So first and foremost, let's look at an ugly report. And I can tell you that this is extremely common, particularly if they're using QuickBooks or any canned system. So what do I mean by an ugly report? I'm going to give you an example. This to me is an ugly report. This is a balance sheet. I'm going to thumb through this for a second, but I want you to look at it and I want you to interpret it as quickly as you can, right? Look at that. And then I'm going to go to the next page. Okay. Look at that. See if you can get to the bottom of what's going on. Okay, I see my pre-page, but go to the next page. So those are 3 pages that came out of a balance sheet of a client. that I just pulled up. Now I changed names, I changed amounts, but the formatting is pretty much the same. So if you look at that, I mean, how often are you given a financial statement that looks like that? I'm going to show you the interpretation of what that is. That is the same thing. Okay? That is the same thing as what we were looking at. But if I were looking at the other piece, I'd look at that and go, I'm not going to spend the time to try and work through that. What I want to get through is I want to see what my total assets are, and I want to see the main components, which are those main buckets. I want to see my current assets. I want to see how much total cash I have. What's my AR, right? Prepaid. So that was just the asset section of a balance sheet. And this is what it should look like. So what I do, and what I would suggest for you to do, is when you do your financial statements, the first look, do it at summary level. Don't do it at that detail level or it's just going to lose you. And look at the summary level and compare month over month. Like I had mentioned, look month over month. See the anomalies. Whenever I have someone give me a financial statement, I usually tell them to give me a 12-month trailing. Because I can look at a 12-month trailing and I can see my AR, what it's trending, or if it's going way down. I like to spot trends in my balance sheet, right? Comparative. So this is a better looking report than your ugly report. Next, there's my summary. So keep it simple, summarize level, and organized, and it'll be much more usable to you, and you'll be able to make much better decisions with it. Inaccurate information. If you've got inaccurate information and you receive it once or twice, you're not going to rely on that information. Once you stop relying on that information, you're going to stop asking for that information because it's wasting your time. And then once you stop asking for it, then you stop having it, and then you fall back into that pitfall of not knowing where you are at on your business. So what causes inaccurate information? One of the things has to do with cutoff. Now, in accounting, there's a matching principle. There's also this closed periods, and I want to demonstrate what that means for you. But this matching principle says this, is that you want to match your revenues and your expenses in the period incurred. Okay, I'm going to demonstrate that. But let's talk about this concept of periods. Every month is called a period, right? If I was on a fiscal year or a calendar year, that would be my year. And period 1 would be January, period 2, February, period 3, March, and so forth, out to period 12. And then I'd start over the next year, right? So you've probably heard of periods. Doesn't matter if you call it a period or a month, but 12 periods generally make up your year. I say generally. And so this concept of matching goes like this. So let's say I do a job, or all my jobs, right, that I generate, or I'll say first off, I incur $7,000 of expenses, okay? And I generate revenue of $10,000 for a profit of $3,000, okay? Pretty simple example, but let me show you how the matching principle functions. So if I did the work in May and I billed it in May, my expenses should be recorded in May. And then when I look at my May financial statements for that period 5, I should see a net income of $3,000. Now I've got an idea what's really going on with my P&L for that. Now watch what happens when the matching principle does not apply. And you have to ask yourself the question, have you ever seen this happen? So instead of recording my revenue in May, I record it in July. So I do it in May, and I look at my financial statements from May, and I look at July. What does it tell me? Oh, I got a $7,000 loss in May. And then I've got a $10,000 net income in July. Now notice for the year, it's correct, but if you're managing yourselves on a month-to-month basis, you're going to have to remember in your head that you get to July, oh, that was really for May. Okay, that matches up, right? My job schedule might look the same. And so it causes problems. But that's one of the reasons why you have inaccurate information, particularly at the end of the year, right? And you're doing financial statements on an annual basis, and it gets in the wrong period, the matching principle doesn't happen, it throws your bottom line off. And as a concept, that's why we have this accrual-based accounting. Accrual-based accounting is based on the concept of matching. So in this case, if I incur $7,000 and I know I'm not going to collect the $10,000 to July, I'm going to do an accrual possibly in May, and that might be an underbilling, right? If you know the concept of underbillings, to move this into May so I can have my financials look like this. And then you use a statement of cash flow to understand when the cash is going to come in, okay? But there you go, matching principle cutoff. Another pitfall that I see is the lack of management on the balance sheet. Every one of your balance sheet accounts should be reconciled, in my mind, every month if resources allow for that. But so many times, go to accountants and I ask, what's in that balance sheet account? They can't tell me. And if they can't tell me what's in the balance sheet, they can't tell me the P&L is accurate. So one of the recommendations I would have for everybody here listening is, in your company, ask your accountant, do you have a reconciliation checklist? Every one of your balance sheets should be on that checklist, showing who's reconciling them, who's reviewing them, if it's a different person and resources allow, and when they complete it. Every time they complete it, they simply come in here and put date and review date. It's as simple as that. It seems convoluted, but I'll tell you, having done this many times with companies, if you can institute this, at first it takes time, but in the end, it's going to save you lots of time. So make sure your accountants are using this and getting organized. That will help your balance sheet be accurate. Knowing your numbers is another pitfall that owners oftentimes fall into, is they don't look at the numbers, they don't understand the numbers, and they just go on with life, and there's no oversight, so no one really cares about the numbers. Accountants just put things together as quick as they can. Know your numbers. Now, another area which is a problem is a systematic approach. So do you have any type of systematic approach? Accounting is very routine. If it's not routine, you might have some problems. You might have over-complexity, or you may have some people that are kind of chasing their tails, but you got to have a systematic approach, okay? So there should be a set of discipline that takes time sometimes to incorporate, but you should have a standard set of processes. An example would be at your month end. And I recently had a client down in Cedar City, a decent sized contractor. They didn't have one of these. One of the very first things we did is I asked them, what are you doing at month end? Well, we're not sure, but we know our financials aren't accurate. Well, how do you know you're going to get your financials accurate until you know what you're doing? So the first thing they did, they started identifying their steps necessary to complete a month end. They listed them, they started tracking them. And we found that they were missing steps, right? You miss a step, your financials are inaccurate. You miss a step, you may have to delay your financial statements. So if you've got delayed financial statements, you want them faster, make sure this happens and make sure they're using the month-end checklist. Doesn't need to be overly complex, just they should be using it. Inconsistent usage. Another thing that I find that happens all the time is you guys get really busy. So you might look at it this month, you might look at it next month, you might look at your financials later. But if it's inconsistent, you won't really know your numbers. And to help you be able to make decisions, you should look at them at least monthly. And for every one of the clients that I work with, we always institute at least a financial review on a monthly basis. Now, if they're new to this process and they haven't been doing this, we generally try and do it before the end of the month, and then we try and accelerate it. But set a financial review to where you sit down with good-looking financial statements, right? Not that ugly thing. Demand that. Make sure that they've gone through and vetted it. They've reconciled things. They've looked at it. So when they sit down with you, you know it's accurate and you can rely on them. And then by looking at them every month, you'll start seeing trends. You'll start looking at those percentages. You'll start asking questions and start wanting to refine things. And then it'll get faster and faster and faster to where it becomes a routine. So there's your monthly review. If you haven't set a time, do it. If you're not sure when your people can get you financial statements, you know what, bite the bullet. Just say, you know what, we're going to target this date. And if we don't get that date, we're going to ask the question why, and then we're going to fix it as to why that's the case. Okay, let team members know you are aware. I see this sometimes as well, that the accountants, sometimes accountants have this myopic tunnel vision that the reason they exist is to generate financial statements. That is not the truth, and that's not the reason why accountants exist. Accountants exist to help management and owners understand the financials and understand their positions. So as an accountant, if I don't think that you care, if I'm myopic in my view, I'm just generating financial for the sake of generating financial statements. And I'm working with a client right now who's run into that. And I have the accountant tell me, well, the owner doesn't really care. And I got the owner telling me, I don't know where I am financially. So we're having to marry those two, and we're going to coach the individual to where he makes sure that he lets the accountant know, I do care and I do understand these numbers. Okay. Ask questions. I think this is my last point in time. Don't be afraid to ask questions. And if you understand or you're trying to understand your financial statements and knowing that there's a story, if you don't understand your story, ask questions. They need to be able to answer that. When I say they, your teams need to be able to answer the questions. And if they can't, set an expectation. No, I rely on you to answer these questions. Be able to, make sure they can look at the financial statements and understand your story. If you want to ask your ratio questions, ask them. Make sure they come back with the answers, and that will let them know that you're aware, right? And this monthly meeting is going to be one of the tools by which you can do that. So we've got 7 minutes left here. I've gone through all the slides. I'll tell you, this is my first time doing this online. I'm generally used to doing interaction with the people I'm talking to, engaging the understanding, and it's a little hard here to do that. So maybe we can open it up for just general questions if there are any. And so Dave, if you can help me do that if there's some questions, they would just unmute themselves and they can just ask the question online, or if they want to send a text in, they can do that as well. So let's just take a couple minutes here and see if any questions come in.
Okay,
Got a little echo there, Dave.
Okay, any questions that anybody might have?
Jeff was asking something but was on mute. Oh. Dave, can you unmute him? There we go. There we go.
Are you talking about me?
I thought I saw you pointing at the screen and saying something. So.
I was. I'm talking to somebody here and trying to explain them how this whole system works.
Oh.
That was all.
Okay.
So I didn't have any questions. you had a good presentation there, a lot of good information.
Well, and I appreciate that. I know we went through kind of quick, and I just talked, and that's a little tough sometimes.
Yeah, well, under the circumstances, that's the best we can do.
Yeah. Well, I posed the question to the group, and we could probably even take everybody off mute for a second here as we finish up. Would you say that the things I talked about, have you seen it in real life? Have you seen it kind of happening in your businesses?
Sorry, what was your question again? I had somebody here in my office.
Oh, I was just asking the question, these things that we talked about today, have you seen them apparent in your individual businesses?
Yeah, I have. I'm the accountant bookkeeper for our business, so I do this every day. I got my financial statement out to see how it compares to the examples you were using, and mine looks almost identical.
Okay.
I did make one note that I don't have a total current asset total and a total current liability total on my, so I'm going to add those as soon as we get done here. But
good.
But I do the job cost work in progress schedule every month, and then we have a CPA that reviews once a year is all. But I do monthly financials and everything else, so we can review that. So.
Very good. Well, Dave, we've got 3 minutes here. It doesn't look like they've got questions, so if you want to wrap it up, I think we're good. I just put my information here in case anybody has questions. You're welcome to reach out to me. Welcome to ask questions. Let me know that you're in the session with us, and be happy to answer those questions.
Thanks, David and Dave.
You're welcome. I hope it was worthwhile for everybody.
Great, Dave. Well, thank you for letting me join you today.
Thank you, David, and everybody. We'll get this put on the YouTube channel in the next couple of days. So thank you very much.
Okay, you're welcome.